Hello everyone, and welcome to episode 14. This week's episode will be about SMT divergences. This is one of the most underrated and crucial concepts that is rarely discussed. No one seems to know how to use it properly, and everyone I've seen using it has done so incorrectly. In this video, my objective is to explain everything about it so you can use it properly in your analysis to generate ideas and use it as confirmation for your pre-existing trade ideas. SMT divergences can be a great tool for gaining conviction in your analysis and accurately predicting expansions and reversals. One thing to remember is that I'm releasing these chapters in a proper chronological order from basics to advanced. Every new episode is related and interconnected with the previous ones. The later chapters provide more detailed explanations of the earlier ones, while also introducing new concepts that will be useful in your analysis. I've chosen to introduce you to SMT divergences this week because I believe it's the perfect time for you to learn this concept. This will help you gain conviction in your high time frame analysis or even your low time frame entries. SMTs also consider the key aspect of time, which significantly increases its effectiveness. You will learn how to apply it in a minute. So let's move on. First of all, you can see the layout of the topics I'll be explaining in this episode. They are organized in a logical manner. We're going to start by introducing SMT divergences, then move on to the rest of the topics, such as explaining symmetrical and non-symmetrical markets, and even more. So let's start. First of all, we need to be familiar with what a divergence actually is. Discrepancies or changes in structure between correlated markets and instruments are called divergences. A divergence is essentially when there is a difference or discrepancy in market structure and order flow between two closely correlated assets. When we actively identify these divergences, discrepancies, and variations at key levels and intervals, we are using SMT divergences. Identifying these discrepancies in price at key times and levels between two correlated assets with the help of ICT concepts is what we refer to as SMT divergences, which is smart money techniques. With SMT, we can analyze two correlated markets or assets, compare their structures, and based on this analysis, spot discrepancies or variations. The type of variation or discrepancy will indicate potential continuation or reversals in the market. SMT signals potential continuations or reversals in the market trends, and that is the most important aspect of SMT divergences. The last and most crucial point is that the SMTs should be used as confirmation for pre-existing trade ideas in your analysis. This means that you should never rely on it on its own or use it as a primary factor for generating a trade idea. It must be used as a confirmation tool. We'll discuss in just a minute why you should never use it as the main concept. Moving on, in this slide, we're going to discuss what symmetrical and non-symmetrical market conditions mean, how they work, and how we can use their core concepts in our analysis to gain conviction. Symmetry is basically defined as proportional and balanced similarities found in two correlated or similar assets or structures. Now, since we're using this term on our charts and in our analysis, the definition for us would be a proportional and balanced similarity between two market structures or the order flow between two correlated assets. The degree of similarity or variation will define the type of market structure or condition that we are in. A symmetrical market condition occurs when two correlated assets markets, or instruments move in complete symmetry, meaning they consistently form market structure and order flow without any discrepancies or variations. This type of symmetry and structure leads to the continuation of price in a balanced manner because the market is moving in full symmetry without disproportionate variations or discrepancies. This is what we call symmetrical market conditions. These types of market structures are more suitable for the continuation of order flow and market structure. What this means is, for example, if you have a higher time frame liquidity target in place and you use this type of symmetrical market condition and order flow framework, there will be a much higher probability of success because the market is following symmetry and moving in a particular direction. There's no manipulation happening by market makers or smart money, so you can trade with accuracy and confidence without confusion or doubt. On the other hand, non-symmetrical market conditions occur when there is clear discrepancies and variation between the order flow of two correlated assets or markets. This type of market condition arises when two correlated assets or instruments move in a non-symmetrical market structure, producing different or varying structures. This sort of non-symmetry suggests that there is manipulation happening in the markets, and it signals that smart money or market makers are actively interfering with the charts and price action. This often indicates that a reversal, expansion, or explosive distribution may occur in the market. Non-symmetrical markets signal potential reversals, expansions, or distributions. This discrepancy is called a divergence. You'll notice that before a reversal, expansion, or distribution of price, there's always an SMT divergence at the top or the bottom, depending on the context. When you can accurately integrate this concept with other tools and identify an SMT divergence at a key level and time, you can precisely predict expansions and reversals with a high margin of accuracy. SMT divergences help you predict expansions and reversals at key swing points and levels during critical times. This way, you can tell when a particular trend is going to end and a new one is likely to begin. The main purpose of understanding this is to be aware of the different types of market structures between two correlated assets in terms of symmetry. This knowledge helps you stay cautious and vigilant around price action at specific structures. It essentially acts as a filter, helping you to avoid lower probability conditions and differentiate between the two types of symmetry and market structures. With this concept, you can ensure that you're only participating in fast and explosive expansions or reversals using SMT divergences to guide you. Now let's move on, and I'll explain this topic in more detail. In this slide, we're going to discuss symmetrical market conditions with the help of some graphics. There are two main metrics you'll use to determine whether the market is in symmetry or not. If it follows these particular metrics and filters, then it signals that the market is in a symmetrical condition. If not, and it shows a different structure, then the market is in a non-symmetrical condition. Before we dive into this, remember that we'll be using two correlated assets or markets in these examples, not just any random pair. I'll primarily use the euro versus the US dollar and DXY graphics to explain SMT divergences because they are closely correlated, moving in the same structure but inverted. These two pairs are correlated and their structure is almost always the same. In the next part of this chapter, I'll give you a combination of pairs that you can use for finding SMT divergences while ensuring accuracy. With that being said, let me explain symmetrical market conditions and how to determine whether the market is in a symmetrical condition. When the DXY, the US dollar index, makes a lower low in its structure, and at the same time, a foreign currency like the euro versus the US dollar or the Great British Pound makes a higher high, this indicates that the market is in a symmetrical condition. Let me explain. We know that when the DXY makes a low, the euro versus the US dollar makes a high. This suggests that the market is in symmetry because the structure is the same. If you're wondering why it is inverted, it's because the DXY moves opposite to foreign currencies. Don't confuse inversion with symmetry. They're different concepts. Two markets can be inverted, but still be in symmetry if they follow the same structure. Similarly, when the DXY makes a lower low, the euro versus the US dollar makes a higher high, indicating symmetry because both are moving in an inverted symmetry while following the same structure. Even though the movement may be inverted, the structure remains symmetrical. This type of structure and order flow suggests that the current trend and underlying order flow are likely to continue. But how can we use this idea? For example, in a bullish market structure where we know that the euro versus the US dollar is bullish, we know that it will reject below the lows and break above the highs, consistently moving higher with higher highs and higher lows. At the same time, the DXY will be in a bearish structure, consistently making lower lows and lower highs, moving in perfect inverted symmetry with the euro versus the US dollar. As long as this continues, both assets are in a symmetrical condition, meaning that the underlying order flow or structure for both the euro versus the US dollar and the DXY will continue with no signs of reversal. While we're using the DXY and the euro versus the US dollar as an example here, this concept applies to other markets too. For instance, if you're an index or a commodity trader, you can use the same framework. First, take a benchmark asset like the S&P 500, the ES, or gold, and compare it with an underlying asset such as the Nasdaq for ES or silver for gold. Then compare the price action of both charts. If you find any discrepancies, that indicates an SMT divergence. If there are no discrepancies, it means both pairs are moving in symmetrical market conditions. In this case, the DXY is the benchmark asset, and I'm comparing it with the underlying asset, the euro versus the US dollar. I really hope that makes sense. Now let's move on to the next slide to explain the second scenario of symmetrical market conditions. Another scenario for symmetrical market conditions is when the DXY for the benchmark asset makes a higher high, while the underlying or foreign currency makes a lower low. This type of structure and order flow confirms a symmetrical market condition, suggesting that the underlying structure will continue. This is how you can determine whether the market is in symmetry or not. Now let's move on to discuss non-symmetrical conditions. Once you go through this part, you'll be able to understand the difference between symmetrical and non-symmetrical market conditions. When there is a discrepancy and variation in the structure between two correlated assets, this suggests non-symmetrical market conditions. These non-symmetrical conditions can be used for various objectives, such as accurately predicting market reversals or expansions. To determine and gauge whether the market is in a non-symmetrical condition, we use specific metrics and clear framework. In a non-symmetrical market condition, when the DXY or the benchmark asset makes a lower low, and the foreign currency or underlying asset makes a lower high, but fails to trade above its previous high, this is what we call a divergence or discrepancy in price. This indicates that there is a smart money tool or smart money technique divergence. Such a non-symmetrical structure suggests manipulation by market makers, indicating that the current price action is not confirmed and a potential reversal could be underway. The reason that this is considered non-symmetry is that while the DXY made a lower low, the foreign currency did not make a corresponding higher high. Instead, it failed to trade above its previous high, making only a lower high. Meanwhile, the DXY did trade below its previous low. This shows a clear lack of symmetry in the order flow with varying structure between two assets. The DXY managed to make a lower low, but the euro versus the US dollar could not break its previous high, indicating non-symmetry and suggesting that the underlying order flow may not continue as expected. A potential reversal or distribution could be taking place, which may flip the entire order flow. When you notice these signs in price action, it's important to become cautious about seeking continuation trades, as the market has shown non-symmetry. This decrease in strength of the underlying order flow signals that reversals are potentially underway. Another scenario for non-symmetrical market conditions would be as follows. When the DXY fails to make a higher high, but a foreign currency makes a lower low. This again suggests an SMT divergence, as there is a clear discrepancy in the symmetry of the price action between the two correlated assets, markets, or instruments. If the DXY failed to make a higher high, then the underlying or foreign currency should also have failed to make a lower low in order to maintain the symmetry. However, it did not. Instead, it made a lower low, showing a discrepancy. So the underlying order flow is unable to continue, and the current price action is not confirmed. Now let's move on, and I'll give you an important list of important asset combinations you can use to find SMT divergences or discrepancies in price, which will potentially assist you in your analysis. Below, you'll see a list of assets, starting with the benchmark asset, followed by the underlying asset, which you can use to identify SMT divergences in their price action. For Forex traders, you can use currency pairs such as the euro versus the US dollar and the Great British Pound versus the US dollar, as these pairs are correlated. Another option is to use the euro versus the US dollar and the DXY, which are also correlated but inverted, meaning they still follow symmetry while moving in opposite directions. You can also consider USD versus JPY and USD versus CHF, or AUD versus US dollar and NZD versus USD, as they are closely correlated. For example, using the euro versus the US dollar and the Great British Pound, a symmetrical market condition occurs when both pairs make higher highs and higher lows. When the euro makes a high, the Great British Pound should also make a high. Similarly, when the euro makes a higher high, the Great British Pound should also make a higher high. This indicates symmetry and a continuation of order flow. Conversely, a non-symmetrical condition arises when the euro versus the US dollar makes a higher high, but the Great British Pound fails to do so, instead making a lower high. This scenario is referred to as non-symmetrical conditions. For other types of traders, if you trade gold, you can use the DXY or silver to find SMT divergences. If you trade Bitcoin, Ethereum can be used, or if you trade ES, you can use the Nasdaq. It's as simple as that. Moving on to the next slide, we will discuss how to accurately identify and find high probability SMT divergences while avoiding the lower probability ones. This topic is essential because there are two types of SMT. True SMT, which occurs at specific times and places and false SMT divergences, which form randomly and are designed to confuse and manipulate traders. If you trade every single SMT you see on the chart, you will likely end up losing everything, as that is not the correct approach. Your job is to use certain filters and metrics that will help you wean out the false SMT divergences. This way, you'll only focus on high probability, high quality, and true SMTs, which will ultimately assist you in your analysis. We'll discuss various important filters in the next slide, but remember, you should never trade every SMT. Instead, use the filters I will show you to accurately identify and trade the true SMTs that exhibit specific characteristics and follow particular protocols. If an SMT doesn't adhere to the protocols or lacks these characteristics, you should avoid trading it at all costs. Otherwise, if you pattern trade it without discernment, you know what will happen. Just like in every other episode I've explained so far, I've introduced different concepts and shown you how to apply them logically. Similarly, I will teach you how to trade SMT in a logical manner, grounded in sound reasoning, and only when there is a clear high time frame narrative behind it, along with specific protocols and characteristics. It's crucial not to treat SMT like a random pattern. Doing so can lead to disastrous results and will ensure your struggle financially. However, if you use it as I've taught you, within a logical framework and with sound reasoning, you will set yourself up for success. The key takeaway is to avoid treating SMT like a pattern. Instead, focus on identifying and trading it at key points and market profiles, all within a logical framework, backed by sound reasoning and narrative. That's how to effectively use SMT divergences. In this slide, we're going to discuss the different filters and characteristics that make an SMT divergence strong and true. You can use these filters to identify high probability and high quality SMT setups. First and foremost, SMT divergences should form at key levels, specifically higher timeframe key levels such as order blocks, FVGs, or important swing points like highs and lows. The best and most reliable SMT divergences occur at these key levels. If you find an SMT divergence in a random area, it won't be effective. SMTs only work when formed at key levels, so ensure every SMT divergence you find and trade has this characteristic. Otherwise, don't use or trade it. The next important filter is SMTs formed at CRT highs and lows. CRTs are ranges, and the extremes of the CRT highs and lows are high probability areas for finding SMTs, essentially swing points with high probability. CRT highs and lows are key levels for SMTs to appear. This is a major factor that confirms a CRT and helps select a high probability CRT. For example, if you have two CRTs on two correlated assets, like the DXY and the euro versus the US dollar, and the euro takes out the CRT high, while the DXY struggles to take out the low, this non-symmetrical market condition increases the probability of a high-quality CRT. Therefore, SMTs formed at CRT highs and lows are high-probability setups. When one CRT is purged on one pair, while the other underlying pair is not, this confirms the CRT and gives it a high-probability SMT. The third important point is that the SMT divergence should form at key times. Timing is crucial in price action. You need to match key levels with SMT divergences but also look for high probability SMTs that form at key times, like during the London or New York Opens. For instance, if an SMT forms during the Asian session, it's less likely to be effective, as this is not a key time for EU or SMT in general. Trading SMTs formed during non-key times, like the Asian session, usually won't work. Another important filter is SMTs formed at previous week or day highs and lows. These are key swing points where potential reversals or expansions can happen. SMTs are more likely to form at such key swing points. One critical thing to remember is that you should integrate and combine all these concepts in a logical manner. Don't use any of these filters in isolation, as this would lead to mere pattern trading. Instead, combine these filters with other concepts like key levels, dealing ranges, and market profiles to ensure you're using them correctly. Another important aspect of SMT is that you should only look for SMTs while targeting higher time frame liquidity. The SMT needs to align with the direction of the higher time frame draw on liquidity. If it's in the opposite direction, you shouldn't trade it. Identifying SMT divergences in the direction of the higher time frame liquidity is crucial. Also, there should be proper narrative built around the SMT. High probability SMTs often form during specific market profiles, such as manipulation or reversal profiles, especially when they occur at key times, like the London or New York Open, and also test key levels. If there's SMT at such a profile, it confirms the setup. A discrepancy between two correlated assets further confirms the SMT and can indicate potential reversal. In summary, these are the most important filters for identifying SMT divergences at key times and levels. If the SMT doesn't follow these filters or have these characteristics, you should avoid trading it. Now let's move on and look at some examples of SMT divergences. These examples will help you understand the concept even more. The first example we have here is between the euro versus the US dollar and the Great British Pound versus the US dollar. We've got the EU chart on the left and the GU chart on the right. You can see that both were moving in complete symmetry until they reached close to a key level, specifically a higher time frame key level. Around this key level, you can see that both EU and GU made a high. However, what also happened with those highs is that the high of EU did not test a key level, but GU did. But what's clear is that both formed a high, meaning they were in symmetry for that moment. Next, EU went higher and traded above the high it had made previously, creating a higher high. In contrast, GU failed to make this higher high and instead made a lower high. This indicates a lack of symmetry between the two pairs, and this type of discrepancy suggests potential manipulation. It signals that the underlying order flow may be weakening and a possible reversal could occur. You can see that after the discrepancy in SMT, the underlying order flow did not continue and the price reversed from that point. The reversal occurred because the SMT was formed at a key level, specifically a higher time frame key level, which is why it worked out the way it did. Another important factor could have been that this SMT formed during a key time, such as the New York Open, which would have increased the probability of the SMT even more. This was a strong example to help you understand the dynamics of SMT divergences. Now let's move on to the next example and discuss what we've got there. Here's another important graphical representation of SMT divergence around a CRT. You can see that one asset purged the CRT high at the key time and tested a key level, while the other did not, struggling to take out the high. This created a non-symmetrical condition which increased the probability of the CRT even more. You would have traded this CRT here because it's an important one, thanks to the SMT divergence. Most of the CRTs I take, if you reverse engineer them and compare them with other correlated assets like the DXY, you will notice there is SMT around that particular CRT. That's why I have so much conviction in these types of CRT. This is how you identify high probability candle ranges with the help of SMT divergences. Now let's move on to the charts and look at some more examples. At the top, you can see the NQ chart, and at the bottom, we have the ES chart. We know that both are correlated assets, and they typically move in symmetry. Our objective here is to find the high probability SMT divergence at key times and key levels using the filters I discussed earlier. You need to focus on the extreme swing points where quick expansions or reversals occur, and you will see there is an SMT divergence present. Take a moment to try and spot it. Look at the extreme swing points where expansions and reversals happen, and you will find the SMT. Here you can see that both the ES and the NQ made all-time highs. What happened is, we entered a manipulation profile because both pairs formed ranging profiles earlier, and then the price pushed beyond those ranges. In these manipulation profiles, as we discussed earlier, SMT is most likely to form because they are high probability profiles for SMT divergences. In this case, both ES and NQ tested a higher timeframe key level, and the SMT divergence formed, showing a discrepancy in symmetry. As we all know, non-symmetry suggests that the underlying order flow is not going to continue, and a reversal or expansion in the opposite direction is very likely. That's exactly what happened. Price reversed and expanded after the SMT. This SMT divergence signaled the top of the market. If you recall, this is the monthly CRT high, where price surpassed that high and then reversed. This means the SMT was formed at both a key time and a key level, specifically the monthly CRT. Here's another example. Try to identify the SMT divergence. To find the SMT, remember to look during specific market profiles at important swing points and key levels. Can you spot it? I'll give you a moment. Okay, here you can see we had an SMT divergence because one asset made a higher high while the other did not, showing non-symmetrical order flow. The underlying order flow didn't continue after that. The price reversed from that exact point. This is how you could have predicted a reversal or a potential change in the market structure through the help of SMT. SMT should be formed during certain market profiles, at key levels, at specific times, and around CRTs. That's how you use it effectively. Here's another example. Moving on, we can see that we had a significant SMT divergence, and price reversed exactly from that SMT. The SMT was confirmed. I hope these examples helped you understand the concepts of SMT with clarity. If needed, definitely rewatch the video a few times so that you can fully grasp this concept, like what symmetry and non-symmetry are, what they suggest, and most importantly, where and how to identify high probability SMTs using the filters I provided earlier. Moving on, in the last slide, we're going to discuss some important points regarding SMT that you must remember. You should also write them down. The first point is that the SMT divergences should only be used as a confluence rather than a predominant concept or factor for generating trade ideas. Next, identify and trade SMT at key levels and key times. Avoid trading false SMT at random places. You know how to do this by using filters. The best SMT divergences are formed at higher time frame key levels and key times, aligning with the direction of the higher time frame draw on liquidity. These are some important points that you must note down. Traders, I hope you did understand this video. If you've any interesting ideas or questions, please write them down in the comments. Be sure to backtest this or any other trading strategy you find on Flames in Trading. Once you are satisfied with the backtesting results, be sure to forward test your favorite strategy on a demo account. Only after that can you trade with it on a live account. If you haven't done so already, please consider liking this video and subscribing to my channel so you don't miss out on future content. I do upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter and join my Telegram. Thanks for watching. Till next time, happy trading.